Does all of this position the Fed for a pause in June? Let's ask Michael Schumacher. He's head of macro strategy at Wells Fargo, and he's here on set with me. Welcome. And Chris Grisanti is here as well. He is chief equity strategist and senior portfolio manager at MAI Capital Management. Welcome to both of you. Michael, I will just start with you and the CPI print. Does it pave the way for a pause next meeting?
I think the Fed was really on track to pause anyway, Kelly, but this really takes out a bad scenario for the Fed. The report was pretty much as expected. You can look at headline, core, whatever it might be. Nothing terribly shocking there. Still, if you look at inflation's run rate, it's too high. So Chair Powell likes to focus on, he calls it super core, but services taking out housing inflation, and that's still running at about a 4% annual rate. So above and beyond what he thinks is reasonable, but is it enough to get the Fed to change course and hike? We don't think so.
Even though their own recession, well, the New York Fed's recession indicator, 68% odds at this point. That's largely based on the 3s10 spread, but that's uncomfortably high.
Is that recession a feature or a bug?
Right.
The Fed needs a slowdown, needs inflation to come down. Now, it doesn't want to see a really awful recession, but still a mild one. It's probably really what the Fed wants. It's just tough to make that point in public and to say it.
That's why I thought, Chris, I guess I don't know what else he could say, but Chair Powell explicitly said in the press conference last time that his base case was not for a recession, which really surprised me.
Sure. Well, didn't surprise me that he said that there wasn't going to be a recession because he really can't. But you know, recession is kind of a qualitative thing. I mean, if you slow too much, you ease into a recession. And that, again, I agree with Mike, that wouldn't be the worst thing in the world. In fact, for us equity investors, that would give us an opportunity to buy things at slightly lower prices, yet not fall off a cliff. So I do think, Kelly, we're still in an economy and a stock market that is speeding down a cul-de-sac. It seems happy, but there's really no place to go. There's no outlet here that ends happily in the short term, I think.
And so we've talked about some of the stocks, you know, J&J is one you're looking at now, Dollar General. I think we mentioned Domino's Pizza might be one on a pullback or if the labor market starts to soften. But is it just a matter of waiting then? You know, if we wait 2, 3, 6, 5 months, whatever the number is, you know, that's going to be the macro event?
I think so. And I don't think you have to wait forever. I think there's things you can buy right now. For example, the Johnson & Johnson or the Dollar General. Those are both stocks that would do probably better in a recession relative to their peers. And so you could buy those now. Johnson & Johnson, for example, is doing the Kenvue spin out with Tylenol and other great brands. And that's happening over the course of the year. So that might work even if the market declines. Dollar General is a counter-cyclical business. People tend to shop there more when the economy is slow. So there's stuff you can do now, but I really emphasize with clients, use a rifle, not a shotgun. You have to be really intentional. And since you're getting 5% for your cash, there's really no fear of missing out right now. And that's different than it's been for quite a while.
Michael, do you think the opportunity in bonds right now is a one-off and it's going to go away as we near the end of the year and we're going to look back and go, wow, we got 5% for a fleeting period of time?
It's pretty impressive right now. And part of it on the front end is really fueled by the debt ceiling. And people are saying, geez, do I really want to buy these T-bills in June or August? Maybe not. So you get some pretty wacky yields. 550 is even possible, depending on a particular issue. That's a one-off. I agree with that point. And if you extrapolate a bit down the road, go into next year, and let's say the Fed eventually does cut, you'll see yields come down quite a bit. So yields are probably high for a bit longer, but it won't last that much longer.
Where do you think the 10-year? So we've heard, you know, Sri Kumar, for instance, has said he thinks 275 is kind of the next stop, you know, in terms of major trading moves. Is that on the table for you?
That's a pretty big move. So if you think about it over the next 2 to 3 months, is that plausible? I think the debt ceiling thing would have to go totally off the tracks. So maybe not a default, but prioritizing payments, something like that really feels uncomfortable to a lot of people. And then sort of perversely, they'll buy bonds.
Exactly.
Because they'll say, I need to hide out.
The worse the situation Treasury's in, the more people are going to want to own the long-term debt at least. Then
Agreed.
I guess my final question would be, what does it mean for stocks? If we are going to have this kind of reset in yields, is that going to be supportive, or at that point is it everything going south?
No, it's everything going south at that point. So bad for credit, probably bad for equity. It's just generally a bad result. No one wants to see it. Could happen, but we're definitely advocating people stay light on risk right now.
All right, gentlemen, we'll leave it there. Thank you for your time today. Michael Schumacher and Chris Grisanti.